Howdy, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Wednesday, May 28th, 2025. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been paying attention to Kiss and Dr. Mo, then you need to be a client of 42 Macro. So today's key macro question is, will the hard data catch down to the soft data, or will the soft data catch up to the hard data? Our answer: while we think a little bit of both represents the highest probability outcome, we expect more of the latter over a medium to long-term time horizon, which is 3 to 12 months in our institutional risk management nomenclature. Sorry, let me read that again. While we think a little bit of both represents the highest probability outcome, we expect more of the latter will occur over a medium to long-term time horizon, which is 3 to 12 months in our institutional risk management nomenclature. The May Conference Board Consumer Confidence data is among the earliest confirming evidence of this belief that the soft data will catch up to the hard data. Our forecasts for U.S. growth are now in line with consensus for Q2 and well above consensus for the second half of 2025. For what it's worth, Wall Street consensus has been unsuccessfully fighting our resilient U.S. economy theme since we authored it in the summer of 2022. By late Q3, early Q4, we believe Wall Street consensus will have adopted our structurally bullish paradigm C thesis as their modal outcome. The fact that growth is slowing throughout is the primary culprit for their delayed recognition. Instead of positioning for the continuation of fourth turning inspired fiscal and monetary largesse, plus substantial deregulation, plus reshoring of critical industries, each being a durably positive shock to growth, many investors are myopically focused on the negative shock from tariffs. Let Wall Street consensus remain on the other side of our trades while they continue to get swindled by the mainstream media's overselling of fear that will no doubt ratchet higher in the coming months as still resilient hard data converges towards unresilient soft data. Undisciplined investors will overreact to the growth slowdown and use it to support their confirmation bias. Moreover, congressional brinksmanship regarding the One Big Beautiful Bill Act and incremental brinksmanship regarding trade negotiations are also likely to trigger volatility this summer. Fade it. We continue to believe there is a high probability that the next 20% delta in the U.S. stock market will be higher, not lower. The next 10% delta may be lower, but who cares? Buy the dip until you hear us officially dismiss Paradigm C as the modal outcome. Transition to our 42 macro dashboard. As always, we'll wrap up with a question from our community. This one's titled, "There is no alternative." When inflation and interest rates were low, there was a lot of talk about TINA. There is no alternative to staying invested in the stock market. Now that the bond market is increasingly wobbly and the U.S. dollar is trending down, could that become a theme again? On the other hand, when the risk-free rate is not all that risk-free, wouldn't that imply stock valuation should go way lower? So excellent question. I think there is an element of TINA going on here right now. We certainly see it in gold, and I think we beat all of Wall Street consensus to understanding the geopolitically driven supply-demand imbalance in the treasury market that is now very clearly becoming consensus across global Wall Street, and why we replaced bonds with gold in our systematic KISS portfolio construction process, and that's obviously helped 42 macro clients tremendously in recent quarters. So very much so agree with the view that the risk-free rate is not all that risk-free. And let's be honest here, the 10-year yield, which in my opinion is the interest rate, 10-year nominal treasury yield, that's the interest rate that matters for global financial markets. It's not risk-free to begin with. I mean, there's one is trying to price growth, it's trying to price inflation, it's trying to place the real term premium, it's trying to place the inflation risk premium. There are four risks in the market, in that market right now. And so investors need to be aware that some of those risks, when they increase, are favorable for stocks, i.e. when the bond market is worried about a positive shock to growth, that is favorable for stocks. When some of those risks increase, i.e. the bond market is concerned about treasury supply and how that may drain liquidity, that is negative for growth. So I think you have to take it all in stride and understand the fact that, yes, the increase in global bond yields, which again, this geopolitically driven supply demand in the treasury bond market is not, it's not, specific to the treasury bond market. We are observing it in Japan, and we're very likely to observe it across Western Europe once they really start to turn on the fiscal spigot and as a function of their remilitarization and their deepening industrialization policy. Once we, start to see more of that, you're going to start to see some headwinds from an equity valuation standpoint. But I think it's very important for investors to remember that, when you focus on, most people focus on, when they're in a bull market, most people focus on valuation as being a catalyst for downside. And that is, I guess it's an appropriate thing to do if you don't do the actual work to identify the trigger. When you think about managing financial market risk, it's always about, so many people spend too much time focusing on vulnerabilities because that's the easiest thing to spot. Those are the easiest charts you can pull up on Fred, the easiest charts you can pull up on World Bank or IMF.com and say, hey, here, look at this vulnerability. Here, look at this market cap to GDP ratio. Here, look at this price to earnings ratio. That's the easy part of investing. The hard part of investing, which is what us institutional investors get paid tons of money to figure out, is the trigger, the timing of when you go from vulnerability to problem, or when you go from, upside risk to actually bull market. That's the trigger, what the catalyst, the timely catalyst that causes markets to flow assets from one asset class to the other, or to create capital formation or capital destruction. The trigger is what we get paid tons of money to figure out. And at the end of the day, I think one trigger that investors are missing when they approach U.S. equity market valuation is the fact that the market itself continues to be increasingly dominated by more profitable companies. I'm going to take you to a chart here, my Bloomberg here, that just shows the share of U.S. equity market cap across 3 different indices represented by the tech sector. So right now, the tech sector is 31% of S&P 500 market capitalization. That's up from 13% in September of 2002. It's 34% of the Russell 3000 index market cap, and that's up from 14% in November 2008. And it's 29%, the Bloomberg Mag 7 market cap. So the 7 companies, the Mag 7 companies are 29% of the Bloomberg US large cap market index market cap, up from 8% back in March of 2015. So the fact that these incredibly profitable, high free cash flow generating companies that should have significantly higher valuations than regular companies are representing greater and greater shares of overall market cap means the actual index market cap itself should be gravitating higher over time. People approach valuation like it's a stationary metric, and even worse, a lot of investors approach valuation like it's a stationary time series, and they think because it's at the top end of the range or at the bottom end of the range that it automatically has to reverse. That is a horrible way to invest. If you learn nothing from me in 2025, do not do that. Do not look at a valuation chart and go, I got to take the other side of this because, I'm smarter than the market. You're not smarter than the market. I'm not smarter than the market. No one is smarter than the market. The market is the market. The market is smarter than all of us. And so one of the things that I think we need to be humble about is the fact that the market composition is changing and has continued to change. And boy, if they're right, if the bulls on AI are right, if the Dan Ives of the world are right on AI, then we're going to see new valuation paradigms that don't make sense to valuation-oriented investors that are looking backwards at a valuation time series that we're trying to tell you today should be non-stationary. Over time, valuation should gravitate higher as margins expand for the average business and as cash flow and profitability expand for the average business. This is not 1825. This is 2025, where companies in the U.S. market are better at generating profits and revenue and sales and earnings and ultimately earnings per share than they used to be, broadly speaking. Now, that's not true for every company or every industry, but broadly speaking, when the index goes from, 10% tech, and some smaller share than that, consumer communication services, to 30% tech and like 20-something% communication services, you have to acknowledge that shift and understand that, even though you have things like bond yields dragging down valuations, there are fundamental dynamics that are dragging up valuations. So that's a long-winded way of me saying always respect the full distribution of probable economic outcomes, not just the side of the distribution your confirmation bias is telling you to focus on at the time, especially because of not because of some lagging or ill-conceived valuation analysis. So we'll wrap it up there. Darius still here presenting our macro minute for was it Tuesday or Wednesday? Wednesday, this short week, Wednesday, May 28th, 2025. Best of luck out there today. We'll catch you back here tomorrow. Cheers.